Hello, and welcome to this video on selecting a good stock. Investing in the stock market can be a great way to build wealth over the long term. Step 1. Determine your investment goals and risk tolerance. Determine your time horizon. Your time horizon is the length of time you plan to hold your investments. If you have a long time horizon, you may be able to tolerate more risk because you have more time to recover from any losses. Risk tolerance is your ability to handle fluctuations in the value of your investments. Step 2. Conduct a fundamental analysis. Expenses, profits, cash flow, management team, competitive advantages, growth prospects, and intrinsic value to see whether the stock is undervalued or overvalued. Besides, examining key metrics, including earnings per share, EPS, price to earnings, PE, ratio, debt to equity ratio, revenue growth, and profit margin, and comparing a company's financial ratios, such as price to earnings ratio, PE, price to sales ratio, PS, and price to book ratio, PB, with those of its peers in the industry, like the industry in which a company operates, including its competitors, market share, and growth potential. Economic factors, such as interest rates, inflation, and GDP growth, can impact a company's or an asset's performance. Step 3. Conduct technical analysis. Technical analysis involves analyzing a stock's price movements and volume patterns to identify trends and potential buy and sell signals. Popular technical indicators include moving averages, relative strength index, RSI, and MACD to identify trends and patterns in the price movements of a security or an asset. Technical analysts also identify support and resistance levels where the price of a security or an asset has historically found support or resistance. Trend analysis is also essential to identify trends, such as uptrends and downtrends, in the price movements of a security or an asset to predict future price movements. Step 4. Consider the industry and sector. Considering the industry and sector is essential to both fundamental and technical analysis. Understanding the industry and sector can help investors identify trends and opportunities and evaluate the risks of investing in a particular company or asset from its performance and prospects for growth and growth potential and risk factors. Step 5. Review analyst reports and news articles. Analyst reports and news articles can provide valuable insights into a company's financial health, growth prospects, industry trends, and the potential risks and opportunities associated with investing in a particular company or asset. However, it's important to remember that these reports may be biased or incomplete. Step 6. Evaluate the valuation. Finally, it would be best to consider whether the stock trades at a fair price based on its financials and growth prospects. One standard valuation metric is the PE ratio, which compares a company's stock price to earnings per share. A high PE ratio may indicate that a stock is overvalued, while a low PE ratio may indicate that a stock is undervalued. Price to earnings, PE, ratio is a valuation metric that measures a company's current share price relative to its earnings per share, EPS. The PE ratio is one of the most widely used valuation metrics in the stock market and can be used to compare the relative valuation of different companies or sectors. It's important to note that the PE ratio can vary widely depending on the industry and sector in which the company operates. Some industries, such as technology or healthcare, may have higher PE ratios due to their growth prospects and potential for high earnings growth. In contrast, more mature industries like utilities or consumer staples may have lower PE ratios due to their lower growth prospects. Investors should also be aware that the P/E ratio is just one metric used to evaluate a company's valuation and should be used with other metrics such as price-to-book ratio, dividend yield, and growth prospects. So, looking at the underlying earnings trends and potential for future growth is essential when evaluating a company's P/E ratio. Diversify your portfolio and consult a financial advisor before making investment decisions. Please hit the subscribe button if you enjoyed my video. Thank you for watching.